Your Dow's still down a good amount today. There you go, by about 130 points. S&P hanging positive, but there's the Nasdaq, Weiss, getting off the mat, picking itself off the floor. Thank you, Amazon. Rates have stabilized a little bit. We're at 485 on the 10-year. The data's a bit mixed. How do you assess what's been a really difficult week? Utilities are the best sector. That tells you everything you need to know, doesn't it?
It does. We'll see how long that can last, because I think you're going to see the yields move up again, absent an expansion of the conflicts in the Middle East. And the reason I say that, if you look at the Treasury auction, I think it was on Tuesday, it was kind of punk, right? And I think that's going to continue to be the narrative going forward. That's going to pressure rates. Look, the market was due for a bounce, and Amazon was as good a reason as any. Plus, I think in reflection on Meta's earnings yesterday, which I thought were pretty good, I thought they were actually great, that the market said, hey, you know, we can pick and choose here. But in my view, this is just a momentary respite. That the die is cast, the economy is going towards recession. I think some critical companies in the earnings reporting season have missed and missed badly, and the market is just punitive. Underlying volatility in single stocks is just the largest I've ever seen, the highest I've ever seen. So I think that gives caution. And as I've said many times recently, the risks outweigh the rewards. And there's a time to play and there's time to wait, because your return is definitely defined by your point of entry.
Yeah,
this is not the point of entry.
You're playing a little bit more, though, than, yeah, look, you bought more Meta.
I did.
You bought more Microsoft.
I did.
Right? Yesterday.
Yeah.
As those stocks had, obviously had some troubles, even with decent earnings, it's in Microsoft's case. And you have Amazon, too. So it's not like you're running for the hills. You're actually getting a little more invested in the biggest names within the market. Yeah,
well, let's go wider in the portfolio. So yesterday, I was actually net short yesterday, not necessarily at the beginning of the day, but going into the earnings for Meta, I was short.
Through the Qs, right?
Right, through the Qs. I was short. Multiple calls on Meta. I was short. The 30s, the 37s, the 42s, or whatever. So look, they didn't offset the loss there, but it was unbelievable trading. I got into Meta. I traded it yesterday. Got in way too early. I got in and was only down 6, and then thought I was a hero, and then it's down 18. So I really loaded up, down 17, sold part of that. But now my position right now is double what it was going into yesterday. So there's opportunity. In terms of Microsoft, shouldn't be down at all. Trade down with the market. As I've said, and as their earnings bore out, this is the #1 play in AI. So I'm happy to take on idiosyncratic risk on fundamental stories from bottoms-up analysis, but not willing to take on broad market exposure. I don't have to.
Jenny, in terms of Amazon, I mean, it's been a tough week. Let's focus on mega cap. I think that's where people really need to know what's happening and what may happen from here and what the broader implications are for the overall market. Did Amazon just save us, the Nasdaq, from a bigger plunge that seemed to be putting itself together?
Maybe. I think probably. And I'm thinking about the conversation we had a couple days ago where you said, are these guys tired? And I said, they're exhausted, right? So when you say a bigger plunge, probably yes. But what does that mean from here? I don't think if it saved us from a bigger plunge, I don't think it means that it's going to reform a bottom and we're going to have a huge move up, because when Steve says Microsoft shouldn't be down, it shouldn't be down based on the story, but I think they all should be down, or at least need to take a pause based on the fact that these stocks collectively, the mega caps, are up 55% this year.